We've already learned the basic components of detailed costing and also the steps for detailed costing. Now let's take a look at one unit price sample from RSMeans manual. And this is a sample project called Pre-Engineered Steel Building. And based on the scope of the project, you can figure out what are the line items need to be extracted from this work. So those are line items, and you can find corresponding line number from the RSMeans book, and the description you can put it over here. And in terms of quantity takeoff, first of all, we need to look at the units being used by RSMeans book, and then based on the unit measure, then you can calculate the quantity from the working plan. So sometimes you need to be careful because something may be just measured by volume. Sometimes you just need to calculate the area. It really depends on the unit measure. Then you can do it backward, try to calculate the quantity. Instead of first figure out the quantity, then figure out whether this quantity will match with the RSMeans book's unit. Once you take off the quantity, the next step is to try to figure out the unit price for material, labor, and equipment. So for this sample, for this example, we didn't really include the unit price for material, labor, and equipment. The unit price for material, labor, and equipment. Instead, it just list out all the costs for material, labor, and equipment. But for your calculation, you need to include the unit price for material, labor, and equipment so that you can do a multiplication to get the material, labor, and equipment cost for this line item. And in this example, we also have a subcontract. So in this area, in division 8, and those are the subcontracts. And then instead of having those material, labor, and equipment costs for the subcontract work, we just receive the quote from subcontractors and tabulate the number into this spreadsheet. So once you figure out all the line items and associated material, labor, equipment cost, and also the subcontracts, that's all your direct costs. So now we can just add them up and start figuring out the indirect cost. So here, this is the general requirements. So again, general requirements is job specific. We just have a 7% out of those direct costs, and based on those numbers, and you can type in the general job specific overhead, 7% of it, and then you can do another estimated subtotal, the direct part plus the general requirements, and you get a different number. Now let's come to the sales tax, and as we said before, the sales tax typically impose on material, equipment. So labor, we don't charge sales tax. So for the labor, we're going to talk about other things. For the subcontracts, and you will find out that we assume 50% of subcontract amount are from material and equipment. So instead of having a direct 5% on for this number for this subcontracts, we first take half of this number and then times this 5% to get the sales tax. Again, the sales tax rate is really dependent on the location of the project. This is just one example, and then we do another subtotal. Now we come to the general contract overhead and the profit. So for general overhead and profit, this example assumes 10%. But still, I would like to point out the general contract overhead and profit for labor is going to be different, because for labor we have to pay their fringe and benefits. Fringe benefits rate is going to be much higher than the typical overhead and profit, because you have to buy the insurance for those labors. So even though you just pay your labor, for example, $25 per hour, but the cost to the contractor is going to be different, to the employer is going to be different, because you have to purchase some insurance for them, liability, those type of things for them, and the cost is going to be more for the employer. So that's why here we put a 53% on top of this bare labor cost. So this portion is called bare labor cost. And then we can do another subtotal, and we add them together, get a estimate total. Then we need to assign contingency. Contingency is used to account for risks. So for this particular case, we assign 5% contingency. Again, this is just a simple approach. It really depends on the type of risks that you are facing. If the project is very risky, you probably need to increase the contingency to a higher percentage. And then you add another subtotal. So now we come to the bound part. So the bound here, the equation can be a little confusing. So it looks like this is every $1,000 you need to spend $12 on the bound. And then this is a 10% of overhead of profit. So a lot of students, they think maybe this is just a 10% of whatever we got over here, overhead and profit. But what this is saying is, since the contractors are going to purchase bond from the surety company, this is the job they have to do. So whatever the job the contractor is doing, they always would like to charge some additional overhead and profit, because they have to assign some person to follow through this task, and they always make certain profit out of the work that they are doing. So the correct formula for this should be rewritten as every $1,000 you're going to spend $12 on the bound. In addition to that, I'm going to charge 10% as my overhead and profit, so which is 1.1 times of the bound cost. So that's how you come up with this number. If you want to prove it, feel free to calculate using this formula. And then after that, we add this number on top of this subtotal C. We got subtotal D. And the last portion for this is the location adjustment. So the location cost index is 102.3. The national average is 100. So what this is saying is you have to make some adjustment. This number is times 2%. So basically this number, this 695,000, is this number 680 times 1.1023. All right, so this is just basically 2.3% of this number. So that's the complete process of doing detailed cost estimate using unit price from the R. Smith's book. A couple of things I would like to point out of that is for the bound, it really depends on the company's financial profile, whether this company has a lot of experience and their financial situations are good or not. For those companies who are perceived less risk to the surety company, they will probably lower this rate so they can spend less money to buy the same amount of coverage, like your insurance. Some people who has really good credit score, they can get a better rate. And this is just using unit price from R. Smith's book. If your company has already have their own process, feel free to use the company's own approach. Not necessarily we always have to use R. Smith's book, because the company's data is always better than the R. Smith's book. R. Smith's book is just a way for you to reference, just in case you don't have your own cost database or some item which you're not very familiar with. You can have some basis for that.